good advice is worth its weight in gold. Just getting some help in navigating choppy markets.
Well, hi, everyone, and welcome back to Steadyhand's Coffee Break series, where we share insights to help Canadians build and protect your wealth with confidence. Today, we're thrilled to have Ian Tam from Morningstar Canada join us. Ian is a seasoned expert in investing research and has spent years analyzing what works and what doesn't work when it comes to growing and preserving your wealth. Now, whether you're just starting your financial journey or looking to refine some strategies in retirement, today's conversation is really going to excite you. We'll be unpacking Ian's top tips for building and preserving long-term wealth. Ian, welcome. Thanks so much for joining us.
Thanks, David. Great to be here and great to see you.
Well, now you've worked extensively in the investment industry and seen what works and what doesn't work for Canadian investors. So in your experience, can you sum up the foundational principles that people need to really focus on and lean into to build and frankly hold on to long-term wealth?
Sure. Yeah. Thanks, David. It's a great, it's a big question and a lot to unpack. But if I have to sum it up, a few things I would say is, consider what it means for you to get advice. Now, in every Canadian, every retail investor is different. Some are quite knowledgeable or think they are, and some are not. And so the first determination I think most investors need to kind of understand is whether they need that advice and what does that mean? And I'm sure we'll dive into that a bit later. The second, of course, is to have a pretty laser sharp focus on the cost. And when I say cost, it means, what are you paying to either your advisor or the fund managers themselves for being invested? And we can certainly talk about how those costs can stack up substantially over time, becoming in some ways a detriment to your overall wealth at retirement. And the last thing is just really around keeping things pretty simple. I mean, Morningstar has a fairly good mantra. Like our I guess mission statement is to empower investor success, and that doesn't often involve a lot of fancy or nuanced investment strategies. More so, your plain vanilla, reasonable asset allocation, keeping risk in line with your risk profile. That type of thing that's fairly boring. That is your best bet to get to your retirement goals or financial goals.
That's a great summary, a great foundation upon which to build. And in fact, it's great we start with advice. I was able to interview Preet Banerjee, who talks a lot about getting advice into what he refers to as the mass affluent channel in Canada. And we have a video on that, which we'll link to in our notes below. But just tease out a little bit more of your thinking around advice and how important it is for everybody, not just, super rich people.
Yeah, so we at Morningstar put a great deal of value on advice, despite maybe the way that you might read our research. Advice is good advice is worth its weight in gold, and a few things, a few ways that it can, I guess, materialize in terms of your investment success is one, just getting some help in navigating choppy markets. Right now, we're kind of in the middle of this possible tariff situation in the U.S., and of course, everyone's going to be worried about that. To help kind of navigate that and help keep your emotions in check, I think a good financial coach, typically an advisor, will really help you not do anything too crazy and make sure you're not off of your goals. The second is around really all the pragmatic elements of investing, whether that's financial planning or investment planning. There's a lot of value in ensuring that you have a very tangible path towards your financial freedom or whatever your financial goal is. And those are two elements that we think are again, highly valuable to an investor when you have that advice relationship. I wanted to mention that today because in Canada, we were kind of in an interesting place. We're quite far from the US in this regard. So when you look at all the mutual fund assets in Canada, which, if you include ETFs, that's about $2.6 trillion. About 60% of mutual funds assets sit in what we call commission-based share classes. In other words, you're invested in a mutual fund and you're paying one fee, typically 1.7 to 2%. And as part of that fee, you're paying a portion of that fee will certainly go to the asset manager or the mutual fund manufacturer, but a significant portion of that fee also goes directly to the broker dealer or the advisor, in other words. And so because we call this commission-based share classes because it's a bundled fee. You don't have, as an investor, an option not to pay that amount. This is in contrast to another setup setup that we call fee-based advice, where you are certainly paying the fee to the fund manufacturer, but you are paying a distinct and separate fee to your advisor. And so the reason I mention this is because when you're in that bundled situation, when you're paying that, whatever it is, 2% to invest in a mutual fund, you don't have that opt-out option. So you really want to understand the value that you're getting from that advice relationship. So things I mentioned earlier, like behavioral coaching, financial planning, all that great stuff. You really want to make sure you're getting a good deal from that. And so both fees and advice are quite important in this element.
And I would imagine that that is really amplified for people that are getting close to or in retirement. It's one thing to be accumulating your wealth, and there's some pretty simple principles to follow there. But it's another thing when you start to decumulate your wealth, it gets incredibly complex. And we've also done another video about that issue, which we'll also link to. Now, let's talk a little bit more about fees because they are super important. And regrettably, too many Canadians are simply unaware that they pay fees for their investments. But as you well know, investing has costs, and you've just outlined some of them. And those costs can be significant. We talk about bank mutual funds. That's a huge part of Canadians' retirement savings. Hundreds of billions of dollars are invested there. And they can cost over 2% of the assets that are invested. That's $10,000 for every $500,000 in assets. And that's paid every single year. And as you know, that compounds into an incredible profit to the bank at the expense of individual Canadians. And I'm frankly hard pressed to think of too many other annual family expenses at that age and stage that surpass $10,000. Hopefully, with heightened media, Morningstar, for example, and regulatory attention on fees, more investors, and particularly retirees who are now relying upon their savings for a large chunk of their retirement income, are in fact going to become more aware of fees and their impact on investment returns, and consequently, the ability to preserve your wealth. Okay, that's my rant. Am I overamping the importance of fees? Like, how significant are fees when it comes to growing and preserving wealth over time? And what are the key mistakes that you see people make in this area?
Yeah, great question, David. Lots, again, a lot to unpack there. But maybe I'll reframe it slightly differently. So, often you'll hear people say you want to invest early. A young person has a lot of runway, and you want to get into the market as early as you can. And the reason for that is really the essence of what investing is all about, and that's compounding returns. So I'll throw a number out there: $100, invested and growing at 4% a year, so fairly conservative in many views. That turns into about $219 over 20 years. So that's a 20-year compounding period, and that you've effectively over more than doubled your money over that time with 4%. Now flip that kind of equation on its head. Say you're being charged 1% or 2% to be invested with a certain mutual fund or ETF or whatever other thing you're invested in. That's a detriment to how much you end up with after 20 years. So yes, fees are absolutely an important factor when you're investing, simply because of that compounding period. And as a retiree, when you're in your decumulation phase, when you're spending your retirement savings, of course that same effect will still be there. And the other element of that is these fees are charged consistently, whether you do well that year or you do terribly that year. A 5% loss turns into a 7% loss in a year, given the fees. So all of this is really important to consider. Keeping your fees low will certainly help substantially get into your financial goals over time.
So, is there any low hanging fruit strategies that you'd recommend to Canadians to, in fact, lower the fees they're paying, but not sacrifice either the quality of the investment portfolio or, as you said earlier, the access to quality advice?
A good self-assessment on what you require from an advice relationship is very important. So there's a few, I guess, avenues where you can get various, I guess, degrees of advice in Canada. So our regulators have recently deemed this the advice continuum. So we'll start at the very basic or the very bottom, I suppose, in terms of fees. That's the DIY investor. So you're joining a discount brokerage platform. You're doing all your own stock trades, and by regulation, you shouldn't be getting any advice from those fees. Although there is some buzz around that potentially changing. So that's at the very far end. The next step up, I would consider robo advice. So that type of kind of hybrid model has really grown in the recent 5 to 7 years, and that's where you're getting a little bit of advice. So it's automated, but a very important element of the investing process is to understand your own what we call risk profile, which is really an element, a combination of two things: your attitude towards risk. So, are you a gambler? Are you really conservative? What is your overall psychology around taking a risk? And the second is your risk capacity. So, are you a year away from retirement and you need your money out in that year? That's very different than a young investor who's going to be working for 20 years, which has a much larger risk capacity. So understanding those elements is super important, not only to not go out of your element in terms of what you're investing in, but also to ensure that you're matched up with a proper investment, so either an asset allocation or whatever specific investment you're after. So that's super important. Then we step into, I guess, the more full service area. So this is where you have a dedicated advisor. Typically, you'll see this through many of the mutual fund or ETF distribution channels. You're working with someone one on one. You're paying them a fee, whether it's bundled or separate or fee based, and that's where you're really getting that personal touch and that behavioral coaching that we were talking about earlier. The other kind of parallel to that, which I know Steadyhand has done a great job in keeping track of, and not so common in Canada, is fee-only advice. And instead of paying a certain percentage every year for this advice, you're paying a one-time kind of flat fee. And we love this model because you're really decoupling the sale of a mutual fund from the advice that you're getting, and in some ways that reduces the conflict of interest, right? You don't necessarily want to get advice from the same person that's making money off of your investment decisions based on what you buy, and so we want to make sure that is decoupled. So it's certainly a good model, and I know that Steadyhand's a good supporter of that model in Canada. So that's the full spectrum. And there's probably some hybrids of various elements of that along the way. But I think that's the first thing you want to consider is, do you have, as an investor, whether you're new or experienced, do you have what it takes? Do you have the chops to actually understand your own risk profile? And I think that's a very important element that many, especially starting younger investors, it's very difficult to understand. Investing is I would argue it's a fairly emotional, sometimes can be very emotional, I guess, track, but you want to be as, I guess, not as emotional, or you want to kind of remove that. And that's what makes a successful investor. Discipline and staying the course is what gets you to your retirement.
Well, let's finish with a little bit deeper dive on that whole concept of behavior. I reflect back again on Preet Banerjee. He says something to the effect that investing is like 8% sort of technical and 95% psychological, making the point that obviously psychological trumps everything. So I know Morningstar has done some really good research. I think you call it Mind the Gap. Can you talk a little bit about how behavior and behavioral decisions can often either make or frankly break long-term wealth creation and preservation?
Yeah, absolutely. Thanks for referring to that study. So, yeah, this Mind the Gap study that Morningstar runs largely out of our US market every year is essentially a comparison of two numbers. One is, what does the mutual fund manufacturer advertise as returns, like on their website or on their fund fact sheet, versus what does the end investor actually get? And we can derive that number based on asset flows or whatnot. And what we typically find year in and year out is that the investor gets less than what the mutual fund is advertising on their website. And the reason for this, of course, is that psychology, that behavioral aspect, or in other words, market timing. What we're finding is that investors are either chasing trends or buying too late, or they're selling too early out of panic. And what's interesting is that this last year we ran that same study, but specifically across what we call thematic funds. So a good example of this, not to call anyone out, but probably the most recent example of this is Kathy Wood's ARC fund, right? So you're investing in technology or automation or crypto, or in years past in Canada, cannabis, right? These are all thematic funds that track some sort of an idea that that the investor thinks will produce excess returns over time. But these funds tend to invest across the your traditional economic sectors, and so we clump these into a taxonomy called thematic funds. And so going back to the Mind the Gap, is that what we found was interesting. The trailing I think 5 years ending in 2023, that behavioral gap for thematic funds as compared to regular plain vanilla boring equity funds is huge. So let me just pull up the numbers quickly here for you. So in the 5-year period ending 2023, the behavioral gap or the investment gap for the traditional equity fund was about 0.5%. So investors are getting, on average, 0.5% lower than the fund's advertising because of that market timing I mentioned earlier. But for thematic funds, again, in the equity space, that gap was 4.9%. So that's a huge difference when we're talking about any sort of investment gap. And we kind of attribute that to the nature of these types of investments, right? They tend to be exciting. They tend to tell a story. It's an easy sell, fun to talk about at the water cooler or with your friends and family. But ultimately, the results are lacking.
That behavior gap is extraordinary. In fact, it's motivated a chap in the United States by the name of Carl Richards to write a book called The Behavior Gap. And this is one of the little schematic themes that he has to put a fine point on it. This concept of FOMO, the fear of missing out at the top, we've all been subjected to that. And then this concept of fear and capitulation, I think we've all been subject to that. And of course, markets climb a wall of worry, or as I heard it actually better explained, markets are like a yo-yo going up an escalator. And so we just need to have that, frankly, steady hand in order to avoid that. We track the behavior gap for our clients, Ian, and we have a zero behavior gap for our client returns versus our fund returns, which means that our clients are behaving really, really well, which we're really thrilled about. Ian, this has been a fantastic journey. I know we'd love to spend a lot more time on it, and we'll definitely have you back to tease out some more of your tips, but we should probably end it here. We'd love to hear from you, our viewers, if you have any additional tips for wealth preservation, or if you'd like more information on any of the topics that we discuss, I encourage you to drop a note into the comments below. And if you're not yet a Steadyhand client and you're not feeling 100% confident about your retirement plan, we put together a free guide that will help you get started. It's called 3 Simple Steps to Retirement, and it's available for download in the link below. Finally, if you haven't yet subscribed to the Steadyhand YouTube channel, please take a moment to click the subscribe button and ask to be notified whenever we load new videos. Ian, thanks again, and thank you all for watching. I look forward to seeing you next time.